Hi, I'm Ensa Huger, and today I'll be discussing funding options, both traditional and non-traditional for your small business. Specifically today, we'll be going into what the differences are between traditional and non-traditional funding and going into some options that you can invest in for your small business. Lastly, we'll go over how to actually get started on your funding journey. So let's connect. Dave Thomas said, "What do you need to start a business? 3 simple things: know your product better than anyone else, and know your customer, and have a burning desire to succeed." While I think that Dave is correct, you do need a good product. You do need to know your customer and have the tenacity to succeed. I'd argue that most small business owners would say that at some point, whether starting or growing their business, that they've needed funding. And that's what we're going to talk about today. Specifically, what's the difference between traditional and non-traditional funding? Pretty simply put, traditional funding usually involves a bank or a credit union. It's a more formal process, and those funding options usually require collateral or other equipment to subsidize the loan. This includes bank loans, lines of credits, and credit cards. Non-traditional funding, by contrast, simply does not use a formal firm, such as a bank or a credit union. And those options are ever evolving and seemingly endless. So let's go into some traditional funding options. Traditional funding options include primarily bank loans, lines of credit, and credit cards. Bank loans tend to have fixed credit terms, fixed interest rates, and require payment monthly on those loans. Additionally, those are used for major investments, upgrades, acquisitions, and other major projects that you take on within your business. Generally, a line of credit would be the next level of traditional business funding. And these are similar to a credit card, but can be used for purchases that couldn't go on a credit card, such as payroll. Generally, you only pay interest on the amount of the line that you are actually using. And this is best for a business that already has some steady income flow, a decent credit score, and business that has collateral to subsidize the line. Lastly, one of the most common traditional funding options is business credit cards. These are used for reimbursable expenses or expenses that you need to track and keep up with. Many credit card companies offer quite robust tracking and categorization that you can use to help simplify your business processes. Usually the limits on your credit cards are lower than what you would get on a loan or a line of credit. However, they can be extremely useful in building your business credit, especially if you manage the credit card properly. Usually the characteristics of traditional funding include a formal application process. This process could involve submitting financial statements and other financial documents for both yourself and the business, and tax returns for multiple years. It usually may require you to submit it more than once. You may actually have to resubmit documents or submit for longer periods of time in order to qualify. The approval process can be quite lengthy as you're going through underwriting and other processes to get approval. And sometimes you'll have to provide collateral for the loan. There's also not as much flexibility in the repayment terms. So you will have to pay the repayment terms or pay using the repayment terms granted to you by the bank. Usually, traditional funding is a simple transaction, cash or some specific fee. It does not involve equity or any other types of transitions. Traditional is often equated with formal funding. However, there are informal ways of funding your business that I would argue are quite common and thus traditional for small businesses today. Those include personal savings, family and friends, and bootstrapping. Personal savings is probably one of the quickest ways to infuse cash into your business. That's because you don't have to convince yourself that this is a profitable business, and you don't have to jump through any hoops to get that cash into your business bank account. Next layer would be go out into your family and friends. I believe that our family and friends support us in a lot of our business endeavors and sometimes would be willing to contribute financially in doing so. One word of caution here, though, is make sure that you outline those terms clearly with your family and with your friends. If it's a gift, make sure that's explicit. If it's not, then make sure you have understanding of when you'll need to repay these funds and what interest would be associated with it. While getting money from family and friends may be easy, what you don't want to do is ruin any of your really good relationships. Lastly, one option would be to bootstrap. So when you've invested money of your own or money from your family and friends, it then becomes necessary to start reinvesting the profits of the business to grow the business. That's called bootstrapping. You do that by simply keeping your business flexible as you grow. Some simple ways to bootstrap your business include strategic financing terms or strategic credit terms. Simply put, that means having a longer time to pay and a shorter time to receive. Direct-to-consumer brands have this pretty easy in getting the funds from their customers almost immediately, but sometimes have a hard time negotiating terms with their suppliers that give them a longer time to pay. This is one of those areas where you need to be very strategic in your discussions with your suppliers and give yourself as much time as you possibly can to pay the bill and using the cash in the time in between. One of the other things you can do is keep your expenses low and flexible. This includes DIY, literally do it yourself. If you can come up with your own social media post, if you can come up with ways to produce the product on your own, then do that. The less people you have to pay, less companies you have to involve, the lower your expense is likely to be. Also, consider virtual office space. Especially in the world today, there are plenty of remote office tools available to us that keep you from having to pay a fixed rent or the associated utilities of having an office space. Next, you can consider using free versions of software and looking for discount codes or coupons. I think we inherently think to do that in our personal lives, but it's something we should really endeavor to do in our business lives as well to keep our expenses as low as possible. And also think about equity for expertise. This is where incubators come in. Anytime you can get experience or expertise without having to pay, that's a win. You may need to trade some small amount of equity, but that is something that will really keep cash in your pocket. One brand who's had an amazing time using bootstrapping is GitHub. GitHub started in 2008 as a bootstrap company and was then later bought by Microsoft 10 years later for $7.5 billion. Can you imagine starting that off, just bootstrapping your way through and then making it to such a large milestone? Next, let's go into some non-traditional funding options. And the list of non-traditional funding options is quite exhaustive, but we're going to focus on a few that I think are quite relevant these days. Some characteristics of non-traditional funding include a simpler application process, quicker approval process, and distribution of funds. In several of these options, you can go from application, decision, to distribution in a matter of 3 to 10 business days. That's one of the best things about non-traditional funding, is being able to quickly access the funds when your business needs them. Also, prepayment is not as strict. Therefore, you can prepay your amounts back and avoid some of the interest that would be associated if you had kept them funds for the original intended period of time. Also, just keep in mind that there are a growing number of options available. So every day there's new possibilities for what could be available in non-traditional funding. Let's talk about some of the reasons why you would consider non-traditional funding. These include the fact that you might have tried to go to a bank or investors and were denied. Also, if your business has less than stellar business credit score, or you need funding in a hurry. There are a few reasons why you really want to consider alternate funding. Those could include that you've tried to go to a traditional bank and get a business loan or tried to work with investors and have been denied, or you just simply have less than stellar business credit or an unestablished business credit. More than anything, non-traditional funding is perfect for someone who's willing to think outside of the box and put themselves and their business at risk for the greater rewards. So I've grouped these non-traditional funding options into some themes that I think are important to consider. Those include building community, social impact, specific use funding, leveraging relationships, and pitch perfect. Let's go into building community. One of the most commonly used options is crowdfunding. I'm sure that we've all heard of Kickstarters or GoFundMes for businesses that we support. Crowdfunding leverages small amounts of capital from a large number of people. Effectively, you have access to supporters globally. And in an increasingly remote world, crowdfunding is gaining quite a bit of momentum. Specifically, $34 billion was raised in crowdfunding through 2020. 74% of campaigns exceed their fundraising goals and only require about 11 days of preparation. Most campaigns consist of 4 posts throughout an average duration of about 9 weeks. And the expected market for the crowdfunding is going to be $300 billion, or is anticipated to be $300 billion by the year 2030. Some of the pros include that when someone decides to fund your idea through crowdfunding, they don't expect a share of ownership in return for your business. That means that you get to fund your business while staying in the driver's seat of your business in the long haul. These investors also have no expectation of being paid back. Crowdfunders are motivated by a genuine interest in your product or service. They are basically creating your first customer base. Some of the cons for crowdfunding or using crowdfunding platforms include that it can be a lot of work to produce a successful promotional video. And it's one of the key pillars of a good crowdfunding campaign. You've got to have something compelling that people actually want to watch and get excited about your product. Also, platforms like Kickstarter have created the expectation of a perk for funders. This may mean you need to provide a gift or write hundreds of thank you notes, and that is time that you could be using to grow your business. Lastly, while you won't need to repay your crowdfunders, you will need to pay taxes on the revenue that is left after you collect the funds from your crowdfunding campaign. So just make sure you make a note of that. Some good examples of crowdfunding campaigns include the very popular Oculus virtual headset that was purchased by Facebook for $2 billion in 2014. They started as a Kickstarter seeking only $250,000, but eventually raised $2.4 million. Amazing Kickstarter, right? Another example of a great crowdfunding campaign is for the Coolest Cooler. I think most of us saw this making its way across social media, becoming viral. They ended up raising $13 million in their Kickstarter campaign. Sadly, the demand for their product outpaced their ability to deliver the product, and they actually had to raise another $15 million to fulfill the orders that came in from their crowdfunding efforts. So, good problem to have that lots of people want your product. Bad problem is not being able to actually plan for the production and the delivery fulfillment of that product. Another option includes peer-to-peer lending. Peer-to-peer lending, also abbreviated as P2P, is the practice of lending monies to individuals or businesses through a platform online that matches lenders with those borrowers. So there's no formal financial institution in the middle, and you can be borrowing from a group of individuals or one individual who are willing to loan you money based on specific qualifications. Those loans are usually capped at about $35,000, and the interest rates are also oftentimes governed by the peer-to-peer lending sites with some level of influence from the investors. One other option would be pre-selling your products. This has become ever present in our market, especially with economic uncertainty. It allows you to launch your product with little to no upfront capital. And there's also a huge strategic marketing advantage. If you're able to produce a product and promotional video that people get really excited about, then you've immediately got consumers who've become investors. You will quickly understand the market's response to your product or your service offering, and you'll know if they want it. Things you have to remember when pre-selling, though, is you have to manage your customers' expectations. Communicate with them often and let them know what's going on with the product and when they can expect to receive it. Use this time to really build a relationship with your die-hard customers. Make sure you're using every channel appropriate for your communication. This is a great time to test which market channels work best for your die-hard customers. Note that you might have to also provide some discounts when pre-selling, and that those discounts can be phased out over time based on when consumers will get the product. So understand, if it's going to take me a year to actually deliver this product, I may offer a greater discount to those individuals who invested at that point versus individuals who are investing and will get their product in 30 days or 60 days. One good pre-selling example is the company July, the air conditioner company that launched during the pandemic. They were a disruptor in the market and had a 20,000 person wait list despite launching during the pandemic. This company sold $300,000 worth of units in the first days of their fulfillment. They still have a waiting list with monthly slots that are already sold out through September. Now that we've covered funding options that center around building community, let's talk about the funding options that center around social impact and what that means to our communities. One of the first options under social impact is microfinance. Microfinance refers to financial services provided to low-income individuals or groups who are typically excluded from traditional banking. Most microfinance institutions focus on offering credit in a form of small working capital loans, which are sometimes called microloans or microcredit. Finca, one of the largest microfinance providers, provides loans and microcredit to industries such as energy, education, health, agriculture, and fintech. They, along with many other microfinance providers, provide equity or convertible notes, usually to early stage companies with business models focused on social impact. So these are companies such as East Africa Fruits or Good Nature Agro or Impalipay, where they're investing in the local communities as well as growing the business's revenue. CDFIs, or community development financial institutions, can be banks, credit unions, loan funds, microloan funds, or even venture capital providers. And they can actually be for-profit or nonprofit institutions. However, they share a common goal of providing financial products and services to specific low-income individuals and businesses in those communities. So even the institutions that are for-profit, it is not their primary goal to make profit, and therefore they're allowed or open to providing funding to companies that other traditional banking institutions would not typically consider. One good example of that is LISC, or LISC, the Local Initiative Support Corporation. LISC is one of the largest and oldest CDFIs. Its role as a nonprofit CDFI is to provide capital projects in low-income, disadvantaged, and underserved communities at affordable rates. Since 1979, they have provided over $24 billion in total investments, to include $1.3 billion in grants, $4.6 billion in loans, and $18 billion in equity, leading to over $69 billion in global impact on the community. Right now, they offer business loans ranging from $100,000 to $500,000 for permanent working capital, leasehold improvements, and equipment. They also provide construction and acquisition loans ranging from $500,000 to $5 million. So this is a great option if those are the types of funds that you need. Now that we've covered building community and social impact, let's talk about funding that is earmarked for specific use within your company. Specific use funding includes examples such as factoring or PO financing. Factoring is selling future receivables for today's cash. Simple as that. The factoring company looks at the fact that you have a constant stream of receivables and is hedging against that. They're effectively going to give you the cash today for the amount of receivables that you have on your books. PO financing is something similar, where a company is actually going to give you funds to purchase the supplies or to have your goods manufactured to offset receivables of those actual goods when they're sold. So in those cases, there's specific use required. So specific use meaning that for PO financing, you actually have to use that money to purchase the supplies or goods that you will ultimately sell for receivables. There's also marketing-based funding. This type of funding is earmarked for ad spend, usually digital ad spend and marketing. Companies that provide this type of funding believe that brands are fundamentally poised to grow if they could invest in marketing dollars, and that those marketing dollars will catapult that growth in such a way that they'll be able to recoup their loan. Some key characteristics of these funds include that they're not given to you directly sometimes. Sometimes for PO financing, the amount is sent directly to the supplier. For marketing-based funding, sometimes the dollars are sent directly to the marketer and not to you. So there's less flexibility and most certainly a specific use associated with those funds. Also, many times repayment is a function of your sales numbers. That means repayment is scaling as your business is scaling. In periods where your business is selling rapidly, then you'll be repaying rapidly. In periods where your business is not selling so rapidly, then you'll be repaying at a slower rate. This is helpful because it just scales as your business goes up and down. But it's also something that you need to make sure you're forecasting, because it is immediate suppression of your cash flow at the top line. Make sure that you've done a cash forecast and know how this will impact you. ClearBank is one good example of marketing-based finance. ClearBank invests $10,000 or up to $10 million in growing online companies based on a revenue share. They provide the capital to grow, and in return are paid a percentage of the revenue until they're paid back. Those percentages can range from 6 to 12% of your total loan amount. Magic Spoon is one good example of that, and they blew past their initial projections of sales for the first few months within the first few days of their sales. So they took on a round of venture capital, but also took on ClearBank financing to specifically invest in marketing. The reason they did that is they didn't want to have increased dilution of their equity. So one of the awesome things about marketing-based finance is that there's no equity involved, right? They're literally just spending on your marketing and getting a flat fee. To date, ClearBank has invested in 4,000 businesses and $1.6 billion over 50 states and 5 countries, and invest heavily in women-owned businesses. So let's talk about leveraging relationships and funding. Revenue-based business loans are being offered by a growing number of firms. Usually these are repaid as a percentage of your revenue, whether daily, weekly, or monthly. And similar to marketing-based funding, it scales with your business. So as your sales increase, your repayment is increasing. As your sales decrease, your repayment in dollars is decreasing because it's set as a percentage of your sales. The amount of loan can be based on your existing revenue trends. And so one of the key providers in this space is Shopify. And they can actually see your daily sales and daily revenue and offer you a loan based on the trends that they already see in your business. It's not ideal for startups or companies that don't already have sales traction because, again, it's revenue based and you haven't actually had any revenue. But it's typically very easy to apply and is linked directly into your sales platform. As I mentioned, Shopify as an example, you can usually apply directly in that platform, and all of the details that they need about your business are usually self-contained. One good example of this is Helena Price, and she's the CEO and co-founder of House, which is the first direct-to-consumer company in the liquor space. She was able to launch during the pandemic or relaunch and grow her business during the pandemic using Shopify capital loans. The next thing we want to go over is short-term loans. And these short-term loans are basically offered with a factoring rate structure. The lender cares more about your daily cash flow than your credit score. So this is really good for companies who may not have a established or strong business credit score. Sometimes the loans cost a little more, sometimes between 10 and 60% of the borrowing amount in interest, and there are more frequent repayments. A good example of that is Loan Builder, which is offered by PayPal. They actually require weekly payments that are auto-drafted from the same bank account that they deposited the funds into. While there are a fair amount of short-term lenders out there, beware that short-term loan markets are also rife with predatory lenders that charge exorbitant fees. Make sure that you find a reputable short-term lender, and you can obtain a potentially large sum of money to fund your small business within a very short period of time. So QuickBooks Capital is another option for relationship-based funding. and really deepening your relationship with an existing partner. QuickBooks Capital offers an application process that is simple and seamless, but actually gives you many possibilities and opens you up to a bunch of different lending opportunities. You can leverage the existing data that you already have in QuickBooks to apply, which makes the application extremely quick and ensures that QuickBooks has all the data they need in regards to your financial records, but also your banking information. That makes decisions quick and funding even quicker. Let's hear more about that from a QuickBooks Capital customer, True Love Honey.
My name is Anthony Tubiolo, and the business is True Love Honey. Somebody sent this kid to the table one day. He says, my dad's a beekeeper in town. He's got a year's supply of honey locked away in his shed, and he wants to know if you want to buy it. So I go there, I purchased a case of it, went and sat on the side of the road with a hat, a chair, and a table, and I sold that honey. We had money to operate, keep things going at a small level, but not to grow. For us, you got no credit, nobody wants to talk to you. One day I'm logging into QuickBooks and a pop-up comes up and says, hey, would you like to have some cash essentially? Could you use some money for extra inventory? And I was like, oh yeah, I could. So I clicked on it. I had $10,000 in less than 48 hours. You want to talk about the importance of like QuickBooks Capital? It's getting equipment, it's getting the things that you need so that you can be efficient, which gives you time. Click, click. It really was that easy.
Wow, what an amazing story. I think listening to True Love Honey's story reminds me that when you really deepen a partner relationship, it can have a pivotal impact on your business. One of the things that I heard him say was that he just logged in one day and it popped up. That is a partner. A partnership is someone who wants to solve a need you maybe haven't even discovered. So relationship building means transitioning from QuickBooks simply being a record keeper and keeping your books to actually partnering with you. And there's no partner greater than one who understands the value of a business owner's time, the limited time that they have. Making their application process and seamless clearly conveys that QuickBooks Capital understands the value of your time. Funding via QuickBooks Capital also allows them to have necessary context about your business. This includes your short-term and long-term goals, as well as hurdles and pain points in your business. They can clearly help you anticipate your need and be there to solve it quickly. So let's go into some other funding options. Accelerators. I'm sure we've all heard of YC or Y Combinator. Accelerators are one of the quickest ways to really grow your business, but it starts after a pretty lengthy application process, and not all are invited to even apply. There are companies that take part in intense mentoring program from just a few weeks to a few months. The accelerator programs offer a wide network of investors and mentors, which can be tremendous help for building your business and raising future capital. Generally, there is an interest fee involved to get into an accelerator, but you also can get actual funding and capital in your business, as well as expertise, which we talked about earlier. Expertise for equity is definitely a way to go. And that's also a fundamental pillar of an accelerator program. So far, one of the largest accelerators includes a company called 500 Startups. So their program is pretty straightforward. They give you $150,000 in exchange for 6% of equity. When you pay that 6% of equity, you get access to their network of investors and experts and a free workspace. And you get to participate in this program that grows your business. The cost to get into that program is $37,000. So far, they've funded 2,200 startups. They've seen 190 exits, and the exit values are in excess of $21 billion. It's an amazing program to go through, as there are plenty. Targets offers an accelerator program that helps businesses that are positioned to actually place their brands and products in Target. Sephora offers one as well that helps businesses grow and scale and place their products in Sephora. So find an accelerator program that is layered with the investors and expertise that you need to best align with the growth of your business and the type of products that you currently have. One of the options that I think people forget in funding is just taking a chance. And that includes both grants and contests and competitions. And I put this one under Pitch Perfect because with a grant or a contest or a competition, you're usually coming forth with a pitch. You're having to really sell your business in an emotional and connectable, relatable way so that people want to actually invest in your business. The most amazing things about grants and contests and competitions is usually it's free money. And what better way to get funded than money that you don't have to pay back, right? So there are a number of grants available, whether from the government or other small sources. You can check out the SBA website for federally funded grants, or just Google. There are plenty of grants available, small and large, to grow your businesses. And some grants are specific to the types of product or business or impact that your business is going to have. The options are endless. And contests and competitions, while they may take quite a bit of time to prepare for, you may actually have to travel or present your idea in public or in a forum of judges. It also is an immediate way to get feedback on your pitch and get feedback on your product from people. And if they like you, in exchange, you get some money. So what better way is it to sell your business, sell your ideas, sell yourself, and practice for what you're going to need to do on a larger stage and then get money in exchange for it? So look online. There are plenty of contests and competitions, pitch competitions available to you. And sometimes they're specific to the industry that you want to be in, but sometimes they're not. And that can be an invaluable amount of feedback for you from people who have the money to invest and have the money to give and can give you clear feedback on your products. It can be time consuming and the probability of funding is not guaranteed. It can be a bit of a waiting game to get the funds because that's just how the government sometimes works. That's sometimes how competitions and grants work. And it may also come with strings attached in how you spend the funds. However, we go back to the biggest win is that it's free money. So you've got to figure out how that free money layers into your business and make sure that it'll work for you. But if it does, go find that free money. Lastly, we're going to go quickly into how to get this journey started, right? It's all these different options available to us. How do we actually make use of them? What is the first step on the journey? Well, the first major thing that you need to do is decide, of all the options that we have, what is the best type of funding available to you? Some things that you should consider is what stage is your business in? Businesses at the startup phase may not be able to get the larger traditional funding from the bank. Also, as we mentioned, you may not be able to get revenue-based funding at the start of your business because you haven't actually generated any revenue, right? So go back and really consider with the different funding options that we reviewed, what stage your business is in and what's most ideal for the stage that your business is in. Then make sure you're clear about what you want to use the funds for. As we went through earlier in the presentation, there are plenty of funds that are specifically used for specific things. And if that's not what your business needs, then that's obviously not going to be the best funding source for you. If you need a greater amount of flexibility, then you'll actually have to consider something that does not have a requirement for you to use it for marketing or for supplies, etc. Then determine the amount of funding you need. And these kind of go hand in hand, right? If you're determining the use, then by default, you should have determined about how much you need. This is where you may need to bring in your accountant or another professional to really help you determine exactly what you need and for how long, and to do some cash flow planning. How long will it take you to repay this? Certain funding options require weekly, daily, monthly repayments. If you need a longer period of time, that may not be the most ideal solution for you. And lastly, determine how soon you need funding. As we went over earlier in the presentation, traditional funding may take a little bit longer to secure. If you need funding tomorrow, that may eliminate some options immediately and lead you towards options that have a quicker application, quicker decision, and quicker distribution of funds. So make sure you're aware of those things about your business. How much do you need? How long will you need it? How quickly do you need it? What do you need it for? Those are things you need to actually be really clear on before you start seeking funding. The other thing you can do is just get prepared. That includes establishing a consistent banking relationship. Sometimes your bank is your best friend in this space. So if you've been with the bank for a while, you can go to them and ask them questions. You know who your relationship banker is. And if you don't, now's the time to go get started. Explore relationships with other existing providers. We talked about QuickBooks Capital. We talked about PayPal and Loan Builder and Shopify. Make sure you research those options and again, determine which one is going to be the best for you and determine if you need to deepen your relationship with those suppliers. One of the things I can't stress enough is prepare your historical financial statements and your tax documents. Get these things in order. If you don't already have them saved somewhere in a folder, organized, now's the time to do that. Make sure you have 2 to 3, and in some cases 5 years worth of historical data where available. If your business is new, you might not have that. We understand that. But go ahead and get as much as you can solidified, as many years as you can solidified of both your business and personal financial records. Create or update your business plan. Going through this exercise is really beneficial for your business anyway, but it also gives you the financial statements and the cash flow plans that you need, but also that lenders may want to see in order to give you the funds. It goes back to what we were talking about earlier in determining how much you need and what you need it for. That should be a part of your business plan. Additionally, prepare a pitch deck. When you've done the business plan, you can pretty much convert most of that content into a simple pitch deck that investors can get excited about. Those pitch decks can include promotional content and videos, which go back to things that you can use in your crowdfunding campaigns. So preparing your business plan and then preparing your pitch deck actually prepares you for a multitude of different funding options. And lastly, objectively assess the value of your business. If you're going to consider venture capital or any other funds that trade on equity, you need to know how much your business is worth. And sometimes this is difficult because we assess a personal value instead of the business's value. Maybe seek some outside advice about how to value your business, but make sure that you do these 2 things. Decide what type of funding is best for you and get prepared. So the key takeaways from our session today is that traditional funding involves banks or credit unions or other established firms. Traditional funding processes are more in-depth and perhaps more restrictive. Non-traditional funding comes in many forms and is ever evolving, but it does not involve banks or credit unions typically. It can be simpler, it can be quicker to obtain, and therefore be the solution that you need in times of quick funding. No matter what you do, no matter what funding option you decide to pursue, make sure you get prepared first. You don't want to be trying to pull together documents or information while actually going through the application process. That makes it more stressful than it has to be. Seek to get prepared now before your business actually needs the funds instead of waiting until the very last minute. That's it for my presentation, guys. I thank you so much for joining. I hope that this was helpful information for you.